Of course, I always like to start off the show with some information and a summary about the market itself for what I saw this week. So this is a chart of the S&P 500 so far for the year. You can see that blue line is the 200-day moving average. Red line kind of is the top trend line that we're watching for right here. And so a couple of things I think are interesting. It's just a little bit of the past history here. So if we go back 3 weeks, okay, this is the chart from 3 weeks ago, we were trying to break through that 200-day moving average, trying to break through that trend line. A really fantastic run. Bottom of the market was June 17th, and that was a huge run up there. And so then, of course, now get to last week, didn't work. We didn't get through that. We ended up kind of falling back down. And of course, this week it's been really good. Actually, last 3 days especially, market is really kind of moving strongly. You can see we actually had a gap opening today as far as that goes. So very, very good. And so, why are we bouncing here? After all of this run up and then back down, why are we coming up here? And number one is we're hitting some support level. You can see here we spent some time bouncing off of this one way or another. Where we are right now. But really, probably the main thing I think that's driving the market is the same things that drove the market back when we hit the bottom in June and drove us back up to these, nearly breaking this trend. And that was just simply that the sentiment, if you look at the surveys, individual investor surveys, or if you look at the surveys that are coming out from the hedge fund managers, the sentiment as far as what they feel the market's going to be doing in, say, the next 6 months is very, very negative. When it gets very negative, oftentimes you'll have a reversal. You'll have the market go up because the people that are left are the positive ones that think there's going to be some type of an increase here. And then the market sometimes just gets oversold, overstretched to the downside. I use that rubber band analogy. Right, so the market's kind of coming down, the pressure to come back and bounce gets higher the more it stretches. They have a technical measure that I use called the Relative Strength Index, the 14-day Wilder's version, which got down to 31. At 30 or less is considered, oversold. So we had that scenario. We had that same scenario back in June. And then we had this huge short positions out there in the market, just like we did in June also. And so all these hedge funds have reduced their exposure to stocks, and they're using, some of that money to short the market itself. That just leaves the people that think it's going to go up to drive it. And so on Wednesday, we had a 1.8% jump in the S&P 500. According to Bloomberg, the highest short interest stocks went up 4.4%. And so you can see what happens there. The market does bounce, get a little bit of movement, and then all these guys are covering their shorts. When they do that, they're buying back the stock, drives the stock even higher, and that can start a rally. And so that's kind of what's happening here. And pretty soon, people start jumping back in, thinking, okay, we hit a low, we're going to go off, and we're going to really run. And I hope that's true, actually, because I'd love to see this market continue through. We have another big resistance area right above us. And then, of course, the 200-day moving average and that red trend line would be incredible to break through as far as that goes. Historically, we have to remember that since World War II, every time we had a market that was down more than 20%, when it recovered more than half of that, which we did in this run-up from the bottom of June, we never got back down to a new low. Not ever since World War II. So that's great. Unfortunately, since World War II, we have not had a pandemic. And so this combination of events, sometimes the history of the market can be, a little bit suspect because this is pretty unique. We've got, a situation with a pandemic, high inflation because of the reopening and the lack of supplies, combined with, the situation that happened in Ukraine especially with the energy prices. So, we'll have to play it by ear here. The way I'm looking at this is it's very difficult to tell. Are we going to go back down to new lows? Are we going to go and skyrocket up through that 200-day moving average? We're right on the edge of where we could fall, and so I think the risk is a little bit higher. The leading indicators are down for 5 months in a row, so that's a big deal. The 2-year Treasury is paying more than the 10-year Treasury for a number of months here. That's an inverted yield curve is a big deal. At the same time, we have this situation where things are softening. Inflation is starting to come down, peaked out in July. Looks like with gas prices and all the other things, we might see it drop some more in August. We do have the CPI report coming out for inflation next Tuesday. That's going to be a big deal. It could accelerate this upturn if things are good in that report. It could stop this upturn if they're bad. So again, I'd be very cautious trying to trade in front of that particular report that's coming out next Tuesday. The 21st, the Federal Reserve has their meeting. Be interesting to see what happens and what have you. I will say that if you look at like yesterday, for example, market was up, even though the Federal Reserve was out in force talking negatively, which is what brought this thing down from the high, here recently, and now it's being ignored more because the data that's coming out is showing a fairly strong employment market. First-time unemployment claims dropped. Number of new jobs is opened, has moved up. And you've got several other things that are showing weakness with, price of oil coming down into the low 80s. The housing market starts are falling and those types of things. That's pretty much exactly what we want at this point in time. We want the inflation, drivers to be softening, yet we still want the, market not to end up in a severe recession in order to bring down this inflation. And so that's where the jobs could be the portion that they can push on and still keep us in what they call a soft landing or the Goldilocks zone. The data is showing at the moment that we're heading into this Goldilocks zone. We'll have to see how that plays out. The real fear here, outside of the potential contagion events that can happen, China's situation and what's going on in Ukraine and those types of things, the fear here in the U.S. is that the Federal Reserve over-raises rates. And essentially, if you listen to them right now, what they're telling me is we're going to over-raise rates if we have to kill inflation, even if it means killing everything else in sight. Now, they might not do that. I think they'll probably chicken out on that in the end. But you do have to take what they're saying seriously because they're wrong a lot. Just last September, a year ago now, the Federal Reserve said that they, on their little statement of economic positioning, that they did not feel 1 year ago that they would be raising rates in 2022. Well, boy, were they wrong. They've been raising rates like mad in 2022, nearly historic rates, or certainly, since the early 80s. We haven't seen rate increases like this, so they're dead wrong. Now, just last week, we had one of the Fed presidents come out and say that we're not even going to have a rate decrease in 2023. Okay, the market is expecting a rate decrease in 2023 because we're going to raise rates. It's going to slow things down so much that they're going to have to start to lower rates or at least stop raising rates in 2023. Again, the market was basically last September, if you look, said that the Federal Reserve was going to be raising rates about 2.5%. That's pretty accurate. We've been exactly in that range. So the market's been more accurate here in terms of the expectations. But that has caused the Federal Reserve to get even more aggressive in their rhetoric because they really, really do not want the stock market to go up because it makes their job harder as far as that goes. So that's going to be the battle. It's why we have right now 18% of our stock market exposure in T-bills and ultra short-term bonds. With the conflicts of good things that are happening in the data and the bad things that are happening with the Federal Reserve's rhetoric and all these different pieces that are out there, I think this is a point in time to be a little bit cautious. So if we have a 100% portfolio, we're still 82% in the stock market. If we have a 60% portfolio, we're about 48, 49% in the stock market. Still lots of exposure. And what will happen is if the market falls farther, we'll reduce our exposure more. If the market comes back up, we'll reduce our exposure to these conservative areas and get back into our normal stock market exposure, especially if we can get back in and break through this 200-day moving average. You can see how important that average is to the market. It got within 1 point of the 200-day moving average. And if you look at the minute-by-minute chart, it fell really hard right away as soon as it got there. So there's a lot of basically selling going on. If we can break through that, I think that could turn into buying, actually. Because historically, when you break through the 200-day moving average in these big downturns, that has been a sign of good things to come. Not always, but most of the time. So that's what I'd be looking for. So this is a time to be patient. wait to see what happens. See what happens with the CPI number on Tuesday. See what happens with the Federal Reserve's, are they going to raise 0.75%, 0.5%? What are they going to do? The market is basically factoring in a 0.75% increase right now. So if that happens, I don't think we'll see a lot of things going on. So it's more of what are they going to say? And then maybe there's a surprise. Maybe the CPI number on Tuesday is better than expected, those type of things. So that's what's happening right now. Just a time to be a little bit cautious. We have our little parachute. We're ready to go if things do get worse, and we're going to react to whatever happens going one way or another. I'm very happy to see the market doing well here the last 3 days. Lots of energy there, lots of motion. So hopefully that continues. Again, a lot of it might be short covering, but nonetheless, when you have short covering enough, you can often get a really big run up, and maybe that'll be enough to get us back through the 200-day moving average. So let's watch and see what happens here. Things will finally get to where they need to go eventually. And we'll figure out what to do as far as that goes. But so just a little bit of patience here, which is exactly what I called for in January. I called for patience about the market this year because this is going to be a tough environment where they're raising rates this much. So anyway, that's what's going on this week. Look forward to talking to you about what's happening next week. Thank you.